When you're trying to learn how to invest, it's like solving a puzzle with hundreds or thousands of pieces. And if you're trying to do it alone, it's like trying to solve that puzzle without the picture on the box. But what if I told you that puzzle really only had 4 pieces? Well, the puzzle is how to invest, and the pieces are why you invest, where do you invest, what do you invest in, and when do you invest. All these pieces build off each other, but by the end of the video, you're going to be able to put them together like butter. So make sure you watch the entire video so you understand how to do that. Let's look at that first puzzle piece, why you invest. Most people are taught their entire lives to save as much as possible, and they're told to just keep adding money to their savings account whenever they can. The problem is, in a savings account, you only earn about 0.01% in interest. So if you save $1,000, you're only making 10 cents a year from that $1,000. You might be thinking that just sounds like free money, but in reality, you're losing money. This is because of something you've probably heard of on the news somewhere called inflation. The United States is always printing more money, so every single year there's going to be more dollars circling around the United States. Because there is more money being added, the value of each dollar itself becomes less valuable. When dollars become less valuable, you can buy less things with your dollars. Let's say you want to buy a $1,000 computer in the year 2025. You decide to wait 1 year to do it. By that same time in 2026, the cost of that computer is going to rise roughly $30. In that time, your savings account only made you about 10 cents, so you're still short $29.90. Inflation is roughly 3% a year on average, so people invest their money to try to grow it faster than inflation devalues it. That's like the definition version of why you invest, but most people think about it is I have this money that I'm not using right now. I'm going to put it aside and get it to work for me to make more money so I can have more buying power than I did today, even after inflation. Now you know why you invest, but now you need to know where you go to invest. And that's the second puzzle piece. So there's many different ways you actually can invest, but for the sake of this video and for beginners, I'm going to be talking about the stock market. This is the easiest to get into because you can do it with the least amount of money. So where do you go to buy stocks? Because you can't just go down to the mall and buy stocks next to the cologne section. You actually have to go through a broker, or nowadays you use a brokerage. There's a bunch of different types of brokerages, but in this video, I'm going to be talking about the 3 most important ones you need to know when you're starting. The first one is called a Roth IRA. And this is a tax advantage retirement account that people use to start saving money for their retirement. What makes it tax advantage is the money you put into it, you pay taxes on now, but when you take that money out, you pay 0 taxes on it, which is very, very big if you make a lot of money in your Roth IRA because you're paying 0% tax, and that could save you hundreds of thousands of dollars in the long run. In a Roth IRA, you can invest in stocks or ETFs or mutual funds. I'm going to talk about those later, but that's just a bullet point to know about a Roth IRA. And even though I think a Roth IRA is the best type of brokerage to open, there are some negatives about it. It has a contribution limit, which is currently $7,000, but this goes up periodically. This just means you can only invest up to $7,000 or whatever that limit is every year. You also can't take out your profits until you're 59.5 years old. Anytime you take out money before then, it is penalized with the exception of the money you put in. So if you put in $10,000, you can take out $10,000 penalty free. There are also income limits when you're trying to invest in a Roth IRA. If you're single, you can't make more than $146,000 before they stop letting you put the max amount of money in. And if you're married and filing together, that limit is $230,000 a year before they start restricting how much money you can put in a Roth IRA. Some places you can open a Roth IRA is Charles Schwab, Vanguard, Fidelity, M1 Finance, and many more. You can make your pick on where to open a Roth IRA. The next brokerage is a 401k or a 403b. These are also tax-advantaged accounts made for retirement. They're nearly identical, but the difference between a 401k and a 403b is a 401k is offered by for-profit companies and 403bs are offered by nonprofit companies, public schools, and churches. These accounts have to be issued by your employer, so if you are not employed, you cannot open any of these accounts. 401ks and 403bs are pre-tax contributions, meaning any money you put into the account is not taxed during the year you put it in, but it is taxed when you withdraw that money later. So if you make $100,000 before taxes and put $10,000 into one of these accounts, you're only going to get taxed on $90,000 of your income for that year. But like I said, you're paying capital gain taxes on the profits. Inside the 401k, you can't really choose what to invest in as much. You're usually restricted to mutual funds or retirement date funds, meaning they just pick a day or a year you plan to retire at, and they will automatically adjust it for you at certain ages. So if your employer has this, that is an easy way to invest. What makes these accounts so good is the employer match feature. This means the employer will just give you free money for putting money into your 401k. If you get the employer match feature, absolutely do it. Usually they do about 100% match or 50% match, and they'll do it up to like 3 or 5% of your income. So if it's 3% of your income and you make $100,000, you could put $3,000 into your 401k and your employer will put another $3,000 in there with you. If it's a 50% match, they'll put $1,500 in there for you. 401ks also have an age limit to withdraw, like the Roth IRA. You have to be 59 and a half to take out of your 401k without any penalties. If you do it before then, you will get penalized. The 401k and 403b also have contribution limits. Currently, it's about 23k, but that also increases periodically. And once again, these have to be provided by your employer, so you can't open these up anywhere outside of your employer. The third type of account you should open is a taxable brokerage account. There is no tax advantages for this account, but you have a lot more freedom inside of it. You do have to pay capital gains on the profits, but you have full flexibility to deposit and withdraw. You can put as much money in as you want, and you can take out as much money as you want anytime. No penalties. There's also no income limits. You can make $20 million and put in $20 million if you wanted to. You get full flexibility on what to invest in, on your choice of stocks, ETFs, sometimes crypto, etc. And this type of account is the best option for your goals that you have before you turn 59 and a half years old. Some places you can open a taxable brokerage account is Charles Schwab, Vanguard, Fidelity, Robinhood, M1 Finance, etc. These are for Americans. You can open up some of these accounts in other countries on some of these platforms, but I don't know as much about countries that aren't America, so you'd have to do your own research there. Before I forget, bonus fourth account. This isn't a brokerage account. This isn't for investing, but I'm going to reference it later, so I'm going to explain it now. What I'm talking about is a high yield savings account, and this is basically just a savings account that earns you more interest. This is a place you can leave your cash risk-free, and it's usually FDIC insured, meaning up to $250,000 is protected for any circumstance. Currently, these high yield savings accounts make between 3 and 5% interest on uninvested cash, which is very good, but that is dependent on what interest rates are at the time. So in the future, this could change, and it will change actually, depending on if rates go up or down. This is great for short-term saving and emergency funds, but this is not an investment. These only make a small percent, better than a regular savings account, but if you're trying to make long-term gains, these are not the places to put your money. These are some online banks on screen that you can open high-yield savings accounts. I'm actually going to make a video in the future about high-yield savings account, so look out for that. Right now, these are places you can open one. Remember the high-yield savings account for later, but right now we're going to talk about the brokerages again. In those brokerages, you actually have to invest in something for it to be an investment. Just having those brokerages doesn't do anything for your money. So that leads us to the third puzzle piece, what to invest in. Like I said, for the 401k and 403b, those usually have a target date fund system where you don't have to do anything. But in the other accounts, you're going to have to pick your own investments. And the best option for beginner investors are usually mutual funds, index funds, or ETFs. Mutual funds and index funds are pretty similar. Mutual funds are just places investors pool their money together and have a fund manager manage that money for them. And index funds are just mutual funds that track indexes which are related to the stock market. Each brokerage usually has their own mutual funds and index funds. To invest in those, you usually need a couple $1,000s minimum to even get started. So the next option for someone who doesn't have that much money is ETFs, and this is what I invest in. You might have heard about people investing in stocks. It's what you do in the stock market, and that's what you're doing by buying an ETF. The thing is, an ETF itself is not a stock. It's just a bunch of stocks in one place that you only have to buy the ETF to have control over. For example, an ETF might have 100 different stocks in it, but you only have to buy that one ETF to have pieces of those 100 different stocks. Let's say, for example, you buy $1,000 worth of one stock. If that stock loses 50% of its value, you lose 50% or $500. But if you buy an ETF that has 100 stocks in it, and one of those stocks loses 50% of its value, you only lose 0.5% of your money, or $5. This is called having more diversity in your portfolio. Most investors strive to have a diverse portfolio, and ETFs make that really easy. Not all ETFs and mutual funds are built the same. Some of them track very risky stocks, and even with the diversity, have a lot of risk. These can trap new investors in bad investments, thinking they have a lot of diversity. So it's important to know which ETFs to buy. I personally have the majority of my money invested in 3 ETFs. They're really simple, they're really cheap, and historically they have done really well. The first one is VOO. This is a Vanguard index fund that tracks the S&P 500. The S&P 500 is just the 500 most valuable companies in the United States. The S&P 500 was started in 1957, and since then has returned an average of about 10%. VOO, the ETF tracking the S&P 500, was started in 2010 and on average has returned about 14.63% in that time. This ETF is also very cheap. To know how much an ETF costs, you got to look at the expense ratio. For VOO, the expense ratio is 0.03, meaning if you were to invest $10,000, you would be charged $3 for this ETF. Considering the S&P 500 usually outperforms the smartest hedge fund managers and the best Wall Street guys, $3 to hold $10,000 of this ETF is very worth it in my opinion. The second ETF I invest in is QQQM. This is a Invesco NASDAQ 100 ETF. The NASDAQ 100 tracks 100 US large cap companies and generally has done pretty well. The NASDAQ 100 started in 1985 and since then has had an average annual return of roughly 14.25%. QQQM is a newer ETF and started in 2020, but since then has returned roughly 15.33% a year on average. This is the most expensive of the 3 ETFs with an expense ratio of 0.15, meaning if you were to invest $10,000 into this ETF, you'd be charged $15 per year. This is a growth-focused ETF. It is good for young investors who have a lot of time before they plan to retire. If you have a lot of time before you plan to retire, you can take a little bit more risk in the hopes of greater returns. And over the long run, this has had higher returns. The third ETF is SCHD. This is a Charles Schwab ETF that tracks the Dow Jones Dividend 100 Index. These stocks are less focused on growth and more focused on consistency, stability, and income. The Dow Jones US Dividend 100 started in 2011 and has an average annual return of 12.25 since then. The SCHD ETF also started in 2011 and had the same 12.25% average annual return since then. This ETF has an expense ratio of 0.06, meaning if you have $10,000 invested, you're paying $6 for 1 year. This ETF is good for someone who's closer to retirement. It's more stable, having not as many big drops, and it also pays a dividend of 3.8%. A dividend is basically just a paycheck you get for holding a stock or ETF, and a 3.8% dividend means if you have $10,000 invested, you're getting paid about $380 a year from that. The dividend changes a little bit over time, but it usually stays between 3 and 4%. Most people invest in just the S&P 500 or an ETF like VOO and do really well long term. But if you do the research and feel like adding a ETF like QQQM or SCHD could improve your portfolio, I think it's not a bad idea. I have a video about this 3 ETF portfolio you can check out now or at the end of this video. It explains more about these ETFs and how you could allocate them in your portfolio. Historically, they have done very well, but past returns aren't a guarantee of future returns. So make sure you do your own research on these ETFs or whatever investment you decide to do. And if you can, talk to a financial advisor, because I'm not a professional. I'm just some guy on the internet. So great. Now you know why to invest, where to invest, and what to invest in. The last part of the puzzle is when to invest. And before you start investing, there's a few things you need to do. To be more specific, there are 3 things you got to do before you start investing. The first one is just make sure your day-to-day expenses are paid for, like rent and food. And then the second thing you got to do is make sure any high interest debt is paid off. Any kind of debt that is charging you more than 6 or 7% should be paid off first. These are things like credit card debt or student loan debt. They usually have higher interest rates and could cripple you financially if you don't take care of them. Something like a mortgage or a car loan, that has a lower percent interest rate can be more manageable. If you're at least making the payments, you don't have to tackle it right away. You should definitely still be trying to pay them off, but you can start investing if the only thing you have is a mortgage and a car loan at low interest. The third thing you need to do before investing is have an emergency fund set up. This should be a savings account that has 3 to 12 months of expenses saved up in cash. If you have a stable job that has a consistent paycheck, you can get away with having 3 to 6 months in a high yield savings account for an emergency. If you were to lose your job, this is just to help you pay all the bills while you find a new job. If you have a job that is like freelancing or you work on gigs and don't have a steady income, you should have 6 to 12 months saved up because you're at a higher risk of losing your income. So you're just safe for a couple months to get back on your feet. All this money should be put in a high yield savings account. You can have 6 months, 12 months of your expenses in cash, getting 3 to 4% interest without any risk of downside. And this will generally keep up with inflation. At least right now it can. So your money will have the same amount of buying power as when you put it in. And in an emergency, you don't have to sell any of your investments, which is ideal. Once you got those 3 things taken care of, now the question is, when do you invest into those ETFs or mutual funds I was talking about? People go to college, they get a finance degree or an economics degree just for a chance to work in Wall Street, to use those big fancy computers to find the best time to invest your money. So you probably think it's very difficult to do, but this is actually the easiest part of the video. You're gonna use a strategy called dollar cost averaging, and historically, people using dollar cost averaging do better than everyone else. Dollar cost averaging just means investing a consistent amount every single week or every single month continuously without selling your position. This, for example, could be investing $100 every week for 30 years until you retire. It doesn't have to be every week. It could be every day, could be every month, but I think every week is a good goal to set for yourself. The reason this works so well is because it takes absolutely no skill or knowledge to do. You just need to be consistent and have discipline in investing every single week. And if you use dollar cost averaging, your money is always working for you 24/7. Not a lot of people know this, but the stock market's returns are heavily carried by their best days. To show you what I mean, here's a graphic that shows you between 1980 and 2020. If you were to invest $10,000 flat at the beginning of 1980, by 2020, that would look like $1 million. During those 40 years, there were over 10,000 trading days where the stock market was live. If you missed just the 10 best trading days, out of those 10,000, your returns would go from $1 million to $460,000. That is $570,000 less dollars by just not being invested in 10 days of that 40-year period. And if you miss the best 20 days or best 30 days or best 40 days, your returns go down significantly. So it's really important to have your money invested every single day. If you're someone that's trying to time when to put your money into the market to get the best possible returns, you're gonna end up missing these best days and end up losing a ton of returns. I'm gonna show you an example of what dollar cost averaging looks like using an investment calculator. For the sake of this video, I'm gonna make a 25-year-old who's trying to retire by 65, so they invest for 40 years. They're gonna start from $0 and they're gonna invest $1,000 a month. During that 40-year period, they're gonna have an average annual return of about 8%, which is lower than any of the ETFs I have talked about in today's video. So if this person has been consistently investing $1,000 a month for 40 years, they're gonna have $3.24 million by the time they retire. So that's why it's really important to dollar cost average and invest consistently. The only hard part about this strategy is being consistent to invest that $1,000 every month. The actual investing part is pretty simple. So that's how you solve the puzzle, how to invest. I make a ton of videos catered to people trying to learn how to invest. Click on this video here if you want to continue expanding your investing knowledge. But if not, thank you so much for watching. Peace.